Welcome back to the deep dive. It is Thursday, February 26th, 2026. And today we are settling a score.
We really are.
Yeah, we're revisiting a story that has been driving us, and honestly, probably your portfolio, absolutely crazy for the last 12 months. We are talking about the heavy hitter of the Malaysian exchange, Genting Malaysia.
And that is Genting with a hard G.
Mhm.
Genting, not Genting.
Right.
We have to get that right out of the gate or the comment section will just eat us alive.
Exactly. The hard G for the hard cash they're finally generating. But before we get into the numbers, and folks, the numbers today are a complete reversal of what we saw 3 months ago. I have a really quick favor to ask.
Yeah.
If you are listening to this right now, please take a split second to hit that like button and subscribe to the YouTube channel.
It makes a huge difference.
It really does. It helps the algorithm find other finance nerds just like us, and it keeps these deep dives coming.
And honestly, if you have been following this saga with us from the absolute despair of Q2 to the sheer panic of Q3.
Oh man, Q3 was rough.
It was. You are going to want to be subscribed for what comes next. Because the script is completely flipped.
It has. So let's just set the scene for anyone who might be new here, or maybe you just blocked out the trauma of late 2025.
Understandable.
Yeah. We have covered the stock extensively. We did a deep dive on Q2. We did one on Q3. And the last time we sat down, the mood was, well, it was grim.
Grim's being polite. It was a bloodbath.
Yeah.
If you go back and listen to our deep dive on Q3 2025, I think we actually titled it, The Paradox. This situation was just maddening. Genting Malaysia had the revenue going up. People were clearly visiting the casinos, but the profits down 79%.
Which we called the Forex shock.
Right, the Forex shock. The Malaysian ringgit was incredibly weak. The U.S. dollar was strong. And because Genting owes billions in USD, the accounting rules basically forced them to recognize massive paper losses.
Right.
So it looked like the company was bleeding out, even though the actual physical casinos were full of people.
And right in the middle of all that chaos, while the stock price was just getting hammered, the parent company, Genting Berhad, swooped in like a vulture.
Yep.
They launched a takeover attempt to take the company private at RM2.6B a share.
Which was a lowball offer.
Totally.
Let's just call it what it was. It was highly opportunistic. They tried to buy out the minority shareholders when the ships were down, pun intended.
And we sat here and we debated it. We asked, do you sell? Do you take the RM2.6B and just run away? Or do you hold the line because you actually believe the New York license is coming?
Well, today's the payoff.
It is.
We have the Q4 2025 report in hand.
Yeah.
We have the full year 2025 numbers. And let me tell you, if Q3 was the cliffhanger season finale where the hero is dangling off a ledge,
Yeah.
Q4 is the season premiere where he pulls himself up, dusts himself off,
Yeah.
and reveals he was holding a winning lottery ticket the whole time.
I love that image. So here is our mission for the next hour or so. We're going to completely rip apart this Q4 report. We're going to look at the headline numbers and explain exactly why they look so good.
And why you should still be a little skeptical.
Right. Always skeptical. We are going to do a deep dive into the 3 geographic engines. So Malaysia, the UK, and the US.
Especially the U.S.
Yeah.
We really have to talk about the New York license today. It is, without a doubt, the single biggest piece of news in this company's history for the last decade.
Absolutely. Then we're going to look at this fascinating, almost Succession-style drama playing out between the parent company, Genting Berhad, and the child, Genting Malaysia.
Oh, yeah.
Because one is rich, one is poor, and it is not who you think. And finally, we are updating the financial Moat score.
Spoiler alert on that one. The score's going up.
All right, let's get right into it. Segment 1, the headlines. Give us the raw data for Q4 2025.
Okay, let's look at the scoreboard. For the fourth quarter ending December 31st, 2025, Genting Malaysia posted revenue of RM 3,012.8 million.
Okay.
That is just over 3 billion ringgit in a single 3-month period. That's a 10% increase compared to the same quarter last year.
Breaking that 3 billion barrier in a single quarter is a massive psychological milestone. I mean, It really shows the scale of the money moving through this system.
It is massive.
Yeah.
But as we always say, revenue is vanity, profit is sanity. And this is where the story gets really good. The net profit for Q4 was RM 123.1 million.
Now, to the uninitiated, 123 million might just sound like a random number, but context is everything here. Where were they exactly a year ago?
Right. So in Q4 of 2024, they posted a net loss of RM 485.6 million.
Wow.
So they swung from losing nearly $500 million to making over $100 million. That is a total swing of over RM 600 million in the bottom line.
That is basically a U-turn at 100 miles an hour. And if we pull back and look at the full year 2025.
Full-year revenue is nearly RM 11.9 billion, which is up 9%. And full-year net profit is RM 670.7 million. That's more than 4 times what they made the previous year.
Okay, hold on a second. I need to play devil's advocate here.
Go for it.
Because in Q3, I distinctly remember you sitting there telling me that the operations were fine, but the currency exchange was killing them. Now suddenly, profits are through the roof. Did they sell 400% more chips? Did everyone in Malaysia suddenly decide to go gamble?
No,
Oh.
no, they didn't. And this is exactly the danger of just reading the headlines without actually reading the footnotes. This right here is what we are calling the Forex flip.
Break that down for us.
Okay, imagine you have a mortgage on a house in London, but your salary is paid in Malaysian ringgit.
Okay.
If the ringgit gets weak, like it did in Q3, your mortgage payment effectively becomes way more expensive. You feel poor, your personal balance sheet just looks terrible.
It takes more of my local currency to pay the foreign debt.
Exactly. But if the ringgit suddenly gets stronger, which is exactly what happened in Q4 2025, suddenly that exact same mortgage payment costs you less ringgit.
Okay.
You haven't changed jobs, you haven't gotten a raise, but on paper, you are suddenly much richer.
So because Genting Malaysia has massive debts in US dollars borrowings that they basically use to build their casinos in America, when the ringgit strengthened in Q4, that debt suddenly looks smaller.
Precisely. In pure accounting terms, they recorded a net unrealized Forex gain of RM 113.8 million in Q4.
Wow.
Compare that to the previous year's Q4, where they had a Forex loss of RM 356.9 million.
So this massive swing in profit is almost entirely due to currency traders pushing buttons in New York and London.
A huge chunk of it, yes. It creates all this noise. In Q3, we were screaming, ignore the loss, it's just currency. Now in Q4, I have to be the buzzkill and say, don't get too excited about the profit because a lot of it's just currency.
But is it all currency? I mean, if we strip out the Forex casino entirely, how is the actual physical casino doing?
That's the exact right question to ask.
Okay.
We need to look at adjusted EBITDA earnings before interest, tax, depreciation, and amortization. It is our best proxy for cash flow from actual operations.
Right, the core business.
Right. And if you strip out the Forex noise, adjusted EBITDA still improved by 8% to RM 578.9 million.
Okay, so that is genuinely healthy. It's not just an accounting trick. The underlying business actually grew by 8%.
Exactly. The engine's running hotter, they are selling more hotel rooms, more food, and yes, more gaming chips. It is a legitimate operational improvement that just happened to be boosted by a lucky break in the currency markets.
That is a very crucial distinction because it validates the thesis we've been talking about, that this is inherently a good business masked by a highly volatile balance sheet.
Correct. And that volatility works both ways. Q3, it hurt them. Q4, it helped them. Investors really need to have the stomach for that roller coaster if they want to hold this stock long term.
Absolutely. So let's zoom in on those actual engines because Genting Malaysia is really a three-legged stool at this point. You've got Malaysia, you've got the UK and Egypt, and then you've got the US and Bahamas.
Yeah.
Let's start with the home turf. Engine 1 Malaysia, Resorts World Genting, the mothership up on the mountain.
The cash cow. At
Yeah.
least it usually is. This quarter, the cow was actually a little skinny.
Really? I always thought the domestic market was practically bulletproof.
It is resilient for sure, but definitely not bulletproof. Revenue for the Malaysia segment in Q4 was RM 1,733.8 million. That is actually down 3% year on year.
Down 3%. Okay.
And adjusted EBITDA, the profit margin dropped by a whopping 21%.
Wait, down 21%. That is a massive margin compression. What is going on up there?
It is a combination of top-line pressure and bottom-line inflation. First, the official report cites lower business volumes in the gaming segment.
Lower business volumes. So does that mean fewer whales? Or just fewer people generally walking through the doors?
It's likely a mix of both. We don't get the exact breakdown of VIP versus mass market in this specific summary, but lower business volume usually means the total amount of money exchanged for chips was lower.
Got it.
Maybe the holiday season just wasn't as frantic as that post-pandemic revenge travel period we saw in the previous years. We're seeing normalization.
People are just settling back into regular habits. And what about the costs? You mentioned bottom line inflation.
That is the bigger issue here. Higher operating expenses. Payroll is up. Contractual obligations are up.
Well, inflation is real. And if you run an entire city on top of a mountain, which is basically what Resorts World Genting is, everything costs more. You have to truck the food up. You have to house all the staff on site.
Exactly. And the Malaysian government has been consistently pushing for higher minimum wages, which impacts the service sector heavily.
Right.
So they made slightly less money at the tables, and it cost them significantly more to run the lights and pay the dealers. That right there is a recipe for a 21% EBITDA drop.
But they aren't just sitting there letting the resort age right. I mean, I saw some notes in the report about new attractions.
No, they're definitely investing. They can't just rely purely on gambling forever. They are really gearing up for Visit Malaysia year 2026.
Which is a huge government tourism initiative.
Huge. And Genting wants to be the absolute centerpiece of it. So they just launched Euphoria.
Euphoria. It sounds like a frantic state of mind, but I assume it's a physical place.
It's a new nature-themed attraction right at the mid-hill.
Yeah.
It's actually quite a smart move. They're trying to capture that ecotourism crowd. People who maybe don't want to sit in a smoky casino but still want to go up and enjoy the cool air, see the flowers.
It diversifies the family appeal, and they're fixing up the golf course too, right?
Yes. The 18-hole course at Resorts World Awana is getting a full revamp. It is all about lifestyle positioning.
Right.
If you can get a family to drive up for the flowers in the golf cart, maybe dad spends 2 hours at the baccarat tables in the evening while they're there. It's the top of the funnel.
So Malaysia is stable overall, but clearly facing some cost headwinds. It's a mature business. It's not really the high growth engine anymore.
No, it is the funding engine.
Yeah.
It generates the steady cash flow that pays for the explosive growth elsewhere. Or at least that's how it's supposed to work.
Let's move to where the explosive growth actually is happening. Engine 2, the UK, and Egypt.
But come back, kid.
This segment used to be such a headache. I remember episodes a few years ago where we seriously discussed whether they should just sell off the UK arm entirely.
And thank goodness they didn't listen to us. Revenue over there is up 17% year-on-year to RM523 million. But look at the profit. Adjusted EBITDA is up 99%.
They essentially doubled their profit in the UK.
Basically doubled it, RM 110.1 million. And remember, the ringgit actually strengthened against the British pound during this time.
Right.
So even though the currency exchange was working against the reported revenue here, dampening it by about 3%, the underlying business was so strong, it just powered right through the currency drag.
What is driving that, though? Is it just general economic recovery in London or something specific?
It is highly strategic. A huge part of this jump is the contribution from the newly acquired Genting Casino Stratford.
Right, the Stratford acquisition we talked about in the Q2 deep dive.
Yes, they bought it, they integrated it, and it is clearly performing. This is crucial because it proves management's competency.
Right, because anyone can run a monopoly.
Exactly. It is one thing to run a monopoly on a mountain in Malaysia where you have literally no competition. It is another thing entirely to buy a distressed asset in a hyper-competitive market like London and actually turn it profitable.
That is a really good point. It shows they can actually operate out in the wild, not just collect rent from a captive audience.
Exactly. And they're not done in London. They finally mentioned the London Trocadero in this report.
The Troc, that massive building at Piccadilly Circus, it feels like it has been in their portfolio forever and just under quote-unquote redevelopment since like the Beatles broke up.
It has been a very, very long saga, but they are finally converting it into a proper high-end casino and entertainment venue. This is prime real estate. If they can get that open and running efficiently, it adds another massive flagship location to their London circuit.
So the UK is absolutely firing on all cylinders. Now let's get to the main event.
Oh, yeah.
The reason we are all here. The reason the stock didn't totally collapse when the parent company tried to buy it out for peanuts. Engine 3, the U.S. and Bahamas.
The star performer. And honestly, the savior of the whole company.
Let's look at the raw numbers first. Revenue RM 714.4 million, up 55% year on year.
55%. In a mature, heavily regulated industry like gaming, that kind of growth is just explosive.
And adjusted EBITDA is up 10%. Now tell me about the Empire consolidation, because I know that's a big part of this.
Right. So this top-line growth is largely due to the full financial consolidation of Empire Resorts.
Yeah.
That's the entity that owns Resorts World Catskills and the Hudson Valley Video Gaming Terminal. For years, Empire was the ugly duckling of Genting.
Oh, it was worse than an ugly duckling. It was a black hole. I remember analysts on earnings calls basically screaming at Genting management, asking why they were bailing out Empire Resorts.
Yeah.
It was losing money. It had massive debt. And honestly, it felt like related party transactions just shuffling bad money around.
It did feel that way. It was known as the Empire Trap among retail investors. But the management kept saying, wait, be patient. We are building a network in New York. And now that network is fully live. The revenue is flowing. But all of that, the Catskills, the Hudson Valley, all of it, that is just the appetizer.
The main course is New York City.
Yes. Buried in the prospect section of this Q4 report is the sentence that changes everything for this company. Resorts World New York City, or RWNYC, has been awarded a full commercial casino license.
Let's pause right here. We really need to explain to the listener why this is different from what they had before, because Resorts World NYC has been physically sitting there in Queens for years. I've been there. It has slots. It looks like a casino. It sounds like a casino. Why does this new license matter so much?
It matters because of the massive legal and operational distinction between a racino and a commercial casino. Before this, RWNYC operated purely under lottery laws. They could only have slot machines, technically video lottery terminals, and electronic table games. You know those big setups where you sit at a screen and a virtual dealer deals digital cards?
Right. It feels a bit like a giant video game arcade.
Exactly. And while that is highly profitable, RWNYC was actually the highest grossing slot floor in the entire world. It has a hard ceiling.
Because of the high rollers.
Exactly. High rollers do not play electronic blackjack. They want to touch the cards. They want to hold the physical chips. They want the real James Bond experience.
And the new commercial casino license allows exactly that.
It allows full, live dealer table games, blackjack roulette, baccarat poker. The real deal.
Baccarat is the key, though, isn't it? Asian high rollers absolutely love Baccarat.
It is the absolute heartbeat of Asian gaming.
Wow.
And Genting, being a Malaysian company with this massive pre-existing database of Asian VIPs, is just perfectly positioned to funnel those players directly to New York.
So simply by taking out a bank of slot machines and putting down a felt table, the revenue potential per square foot just explodes.
It changes the math completely. And crucially, it also widens their moat. New York State is only issuing 3 of these licenses for the downstate area. It is a very closed club. You aren't going to have a competitor opening up a new casino right across the street next week.
This is the New York jackpot we put in the title of the deep dive.
It absolutely is. And think about the timing of all this. This is exactly why that takeover battle back in Q3 was so contentious.
Let's connect those dots for the listeners because this is where the drama really is.
Okay, so rewind back to Q3. Genting Berhad, the parent company, offers RM2.6B to take Genting Malaysia private. At that specific time, the New York license had not been officially awarded yet. It was viewed as highly likely, but not legally certain.
It was a probability bet.
Right. The parent company knew that if they could manage to buy 100% of the company before the license was officially awarded, they would capture 100% of the upside. They would get this massive transformational asset, essentially for free, priced into the depressed stock value.
But the minority shareholders and the independent financial advisors stepped in and said no.
They held out. They said, we know exactly what this license is worth, and it's worth way more than 2.35. And now, here we are. The license is fully secured, the regulatory risk is gone, the asset is tangible.
Which brings us perfectly to the divergent fortune segment of the deep dive. Because while Genting Malaysia, the child company, is celebrating this massive win, the parent company seems to be in a very, very different place.
It really is a tale of 2 balance sheets right now. On the exact same day Genting Malaysia reported these great numbers, Genting Berhad reported a net loss of RM 289.97 million for Q4.
So the child is rich and the parent is broke.
Effectively, yes. Genting Berhad is suffering from a perfect storm of bad news across its other non-gaming divisions.
Like what specifically?
Massive impairment losses. They had to officially write down the value of their assets by over RM 200 million.
Impairment. Let's ELI 5 that for a second. Explain it like I'm 5.
Sure. An impairment is basically the company having to admit to its accountants and shareholders, hey, remember that thing we bought or built for $100 million? Yeah, turns out it's only worth $50 million now. It is a non-cash charge, meaning money didn't literally leave the bank account today, but it destroys shareholder equity on the balance sheet. It is an admission of a bad investment.
Ouch. What else is hitting the parent?
Their power division. The abandoned power plant in Indonesia had significant unexpected outages. And obviously, if a power plant isn't running, it's not selling electricity, that hits revenue hard and fast. And then on top of that, their plantation division, Genting Plantations, got hit with a massive regulatory fine in Indonesia, RM 96.6 million.
A nearly 100 million ringgit fine. That is definitely not a parking ticket.
No, it is not.
Okay.
It creates a severe cash crunch. So look at the dynamic. You have the parent company bleeding heavily from impairments, operational failures, and fines. And then you have the child company, Genting Malaysia, securing the most valuable commercial casino license in the Western Hemisphere and printing cash.
This explains the internal dynamics so clearly. Genting Berhad owns just over 63% of Genting Malaysia. They absolutely need Genting Malaysia's cash right now.
They are completely dependent on it for liquidity. Genting Malaysia is effectively carrying the entire group on its back right now.
Which leads perfectly into segment 4, the dividend discussion. Because usually when a company has high debt, and let's be clear, Genting Malaysia does have very high debt,
Yeah.
they might cut the dividend to save cash and pay down the borrowings. But they didn't do that here.
No, they did the exact opposite. They declared a final dividend of 7.0 cent per share.
How does that compare to previous payouts?
It is up significantly from 4.0 cent in the previous corresponding period. That is a 75% increase in the dividend payout.
Why, though? Why pay out that much more cash when your own internal interest rates are rising?
Two main reasons. One is to appease the minority shareholders, who are honestly still pretty angry about the lowball takeover offer. It's basically a peace offering. Here, have some cash. Please keep holding the stock. Don't vote against management at the next AGM.
And reason 2.
The parent needs the money. Remember, 63% of that massive dividend payout goes straight upstairs to Genting Berhad. By declaring a big dividend, Genting Malaysia is effectively transferring its own cash upstairs to help the parent company pay its own fines and debts.
Ah, the classic upstream dividend.
It is textbook. But look, if you are the listener and you own the stock, you probably don't care why they are paying it as long as the check clears your brokerage account.
Very true. If you're getting a 7-cent yield plus you have the capital appreciation from the New York News, you are probably pretty happy right now.
Exactly. The ex-date is March 13th, 2026, and the payment date is April 10th. So if you are a shareholder, definitely mark your calendar.
Okay, we have been celebrating the wins for a while now, but this is the deep dive. We don't just read the glossy press release. We always look for the bodies buried in the basement. So what are the red flags? What could actually derail this train?
There are three main threats we need to monitor. Threat number one is the debt.
The debt pile is still massive, right?
It is undeniably huge. And more importantly, the cost of carrying that debt is rising. Finance costs for the full year 2025 increased by RM 137.2 million.
Wow.
That is nearly 140 million ringgit just vanishing into interest payments instead of the bottom line.
That is money that could have been extra dividends. That is money that could have been reinvested into the resorts. It is just burning up.
Correct. They recently refinanced some of their debt, but they had to do it at higher market rates. Interest rates globally are just higher now than they were 5 years ago when they originally took on some of these loans. This is a massive drag on profitability that isn't going away anytime soon.
Okay, what is float number 2?
The lawsuit. The Rye Bahamas saga.
I feel like we've been talking about this Rive lawsuit since the very first episode we ever did on them.
We basically have. And the update buried in this Q4 report is not that it's over. The update is that mediation failed in May 2025.
Mediation failed. That is never a good sign.
No, it means the two sides couldn't agree on a settlement number behind closed doors. So now they're proceeding to fact discovery.
Fact discovery is the absolute nightmare phase of corporate litigation. It means armies of highly expensive lawyers digging through millions of internal emails, memos, and text messages looking for a smoking gun.
And we have to remind everyone, the claim here is for USD 600 million.
Do the quick math for us on that.
At current exchange rates, that is roughly RM2.6 billion. If Genting Malaysia somehow loses this case completely, it would instantly wipe out nearly 4 years of the pure profit they just made.
It is a nuclear bomb just sitting there quietly on the balance sheet.
It is classified as material litigation. Now, the management always says the claim is completely baseless. They literally have to say that. But juries are unpredictable. Until this is finally resolved one way or another, it puts an artificial cap on the stock price. Because smart institutional investors are simply afraid of that 2.6 billion ringgit hit.
Right. They price in the worst case scenario. And the third threat,
The parent company itself.
you're talking about governance risk.
Yes. As long as Genting Berhad is in deep financial distress, there is a constant lingering risk that they will force decisions on Genting Malaysia that are bad for the subsidiary, but good for the parent.
Give me an example.
Maybe they force even higher dividends that completely strain GENM's cash flow. Maybe they try another lowball privatization attempt. Or maybe they force Genting Malaysia to, quote-unquote, bail out another failing unit of the broader group by buying some random asset.
We call that related party risk. And in the Malaysian market, it is a very, very real thing to be aware of.
It results in what analysts call the conglomerate discount. The stock perpetually trades at a lower multiple because outside investors are just afraid of the family politics and the backroom dealings.
So we have the New York jackpot pulling them up on one side and the lawsuit and the parent risk weighing them down on the other. How do we balance this? It is time for the scorecard.
The financial Moat scorecard.
In Q3, when things looked bleak, we gave them a 7 out of 10. We said we liked the physical assets, but we absolutely hated the balance sheet volatility and the governance. Where do we stand today?
I have thought about this a lot, looking over these numbers,
Yeah.
and I am upgrading the score.
To what?
I'm giving them an 8 out of 10.
An 8. Okay,
Yeah.
that is a very strong score. That pushes them firmly into blue chip territory. Justify the upgrade.
It comes entirely down to the quality of the moat. A moat in investing is a barrier that protects your business from competition. Securing the New York commercial casino license is the ultimate regulatory moat.
Because literally no one else can build a casino there.
Exactly. You have secured a government-sanctioned monopoly on live table games in one of the absolute densest and wealthiest population centers in the United States, complete with a direct subway line right to the casino doors. That asset alone is worth billions. It justifies the score upgrade because it practically guarantees massive cash flow for the next 20 to 30 years.
And what about the execution?
The execution has actually been really solid lately. They completely proved us wrong on Empire Resorts, turning that around. They turned around the UK business with Stratford. They are managing the Malaysia inflation costs reasonably well given the circumstances. Management has earned some real credit here.
So why not a 9 then? If New York is that good, why not go higher?
Because the 8 is hard capped by the balance sheet. You simply cannot be a 9 or a 10 out of 10 company with this sheer amount of debt and a pending $600 million lawsuit hanging over your head.
Right, that makes sense.
And the governance risk with the parent company keeps it from ever being truly perfect. If they manage to aggressively pay down the debt over the next 2 years and settle the RAV lawsuit favorably, then we can come back and talk about a 9.
That seems very fair. An 8 out of 10 reflects the massive transformational win in New York, but still acknowledges the heavy baggage they are carrying around. So let's wrap this up with a final thought on the what now for the listeners. Because if you are listening to this right now and you held your shares through the RM2.35 takeover battle last year, first of all, congratulations. You have absolute nerves of steel.
You played the poker hand perfectly. You called the parent company's bluff, and you won.
But the game isn't over. The stock price has recovered nicely. The dividends are clearly flowing again. But the parent company, Genting Berhad, is still hungry.
And that is the exact question I want to leave you with today to think about. Genting Berhad failed to buy the company on the cheap at 2.35. Now that the New York license is 100% secured, the company is objectively worth much, much more. Maybe RM 3.0, maybe even RM 3.50 based on a sum of the parts valuation.
Will the parent try again?
Well, if the parent is truly desperate for cash right now, they might not actually be able to afford to buy it. But what if they find an outside partner? Or what if they heavily leverage up to make another run at it? We might very well see another privatization attempt down the road. And the big question is, will they actually offer a fair price next time? Or will we just see another brutal boardroom battle?
Genting the Next Generation. I would honestly watch that show.
I listened to the deep dive about it.
Speaking of which, thank you so much for listening to this deep dive. We know we threw a lot of heavy numbers at you today. Billions of ringgit Forex swings, EBITDA margins. But we really hope this helps you understand what you actually own under the hood.
Because knowledge is the best hedge against market volatility.
Absolutely. If you got value out of this deep dive, please do us a huge favor. Hit like, subscribe to the channel, and I really want to hear from you down in the comments.
Yeah, I specifically want to know, did you hold? When the price dropped and that low ball offer came in at 2.35, did you panic sell? Or did you diamond hand it knowing New York was coming?
Let us know your war stories in the comments. And let us know what stock you think we should cover next. We read every single comment.
We really do.
Until next time, keep analyzing, stay skeptical, and good luck out there in the markets.
Stay informed.